This is Think Smart with TMFG, the weekly podcast of what's newsworthy and relevant to everyday Canadians. I'm your host, Senior Financial Advisor Mike Connon of CI Asante Wealth Management. Welcome to Think Smart with TMFG. I'm Mike Connon. This is Carlo Cancino, Senior Financial Advisor with CI Asante Wealth Management. Carlo, owning a business, it has some great things. It gives you flexibility in your pay when you pay yourself, but sometimes that flexibility can be confusing. Should you take a salary? Should I take a dividend or some combination of both? And these choices impact your tax bill, retirement savings, overall financial outcomes, even if you don't see the immediate consequences.
Yeah, no, and I think we should add that owners typically focus on saving on taxes in the short term, but it's often overlooked how compensation choices affect long-term planning, like RRSP contribution room or Canada Pension Plan benefits. So, Mike, why don't we walk through today the main differences between those options, and let's point out the common mistakes that we see business owners make, and we can share some practical strategies that we've seen to make sure that what you pay yourself supports your long-term goals.
Let's start off with the first thing. Do I need a corporation? A lot of times we get this call because everyone says, people always approach people, oh, you're going to be making some money. You need a corporation.
Right.
And they think a corporation is this magic thing where you don't pay any taxes and it's butterflies and it's beautiful. The reality is within a corporation, the purpose of a corporation is to keep money that you don't need.
Yes.
And believe it or not, if you have a sole proprietorship, it actually has the same tax effect as a corporation if you're spending all your money. There's really no difference between the two. The deductions are the same. What you can deduct is the same. Everything is the same. The trick to the corporate structure is if you don't need to spend the money, you can keep it in the corporation before passing it through that tax wall. Okay. So let's go down into let's say you do have a corporation. And let's say your corporation makes $500,000. Okay. And let's say you have $300,000 with expenses. So in there's $200,000 left over.
Yes.
Right. Okay. Out of that $200,000 left over, let's say to live, you need $100,000 to live. So you can draw that $100,000 out of that company, and there's another $100,000 that you don't need. Now, the trick is, usually when you make money personally, everything you make in there is taxed at your marginal tax rate. In Canada, small businesses have a pretty good tax rate for incomes along that line. You're below $500,000, you're probably paying, was it 12.5%?
Yeah, 12.2. Well, depending on the province, but 12.2 in Ontario.
Yeah, so it's pretty low. If you don't need to take the money out of that company, the taxation inside that company up to that $500,000 is going to be 12.2%, which is pretty low.
Yes.
There's no tax rate that we have personally that's like that. So along the way, whatever you can stop from being taxed at your top marginal rate makes sense to leave in that company. If you're in a structure where you're going to leave some money in the company, and let's say you're going to leave that $100,000 in the company, and you assume you don't need it for anything. Sometimes you need it for liquidity in the company, but let's say it's not that type of company. It's long-term savings. So you can invest that in the company. Now, when you invest that in the company, unfortunately, when you get investment returns, they're not at that 12.5%.
Exactly.
Some people tend to think that. They're like, it's in the company. That's what's going to be out. No, it falls into sort of a 50% tax bracket when you get into that. There's advantages in the company, like you have personally. If you get capital gains, half it goes to the capital dividend account, which can be taken out tax-free.
Yes.
If you get dividend income, there is credits that go back to help you offset some of the tax liability, make sure there's no double taxation. And if you get let's say interest income or foreign income, it's taxed very similarly to how it would personally. It's taxed in your top tax rate. But what we do is now we have this whole situation where we talked about this company. We have that $200,000 in that. And let's say we need $100,000 to live.
Okay.
Now, how are we going to take that out?
Yeah, no, you have the option. You can either be paying yourself a salary, T4 income, and that's going to be a business expense because it's paying. So that could be part of the business expenses and reduce the taxable income for the business, for the corporation.
Yeah, so that example that we used where we had $200,000 have expenses, if you take a $100,000 salary, the taxable income for the business is only going to be $100,000, which is only going to cost you $12,500 in taxes. So that's pretty good.
The other form of compensation, you mentioned it earlier, could be in the form of dividends, but that's going to happen after the tax has been paid. So you're going to have your general revenue and then the expenses, or whatever they are, then whatever's left over is going to be the taxable or the active business income. From there, after the taxes are paid, you have your profit and you could be pulling your dividends out of that profit.
So again, the same example. We have that $200,000 that's left over afterward. You need to take $100,000 out. You take it out and you call it a dividend. Now it's going to be dividend in there. It's going to be eligible dividend. The only thing is in the company, it's not a deduction for the company.
Correct.
So again, as we said, we brought the income of the company down to $100,000 that time with $12,500. If we take as a dividend, the income in that company is going to be $200,000. So you're going to pay $25,000 tax in it.
Yes.
So we've doubled up the tax in the company. But now when you take a dividend out personally, you're paying a much less tax rate than you would be if you took salary. Now, when they work the numbers, every time I deal with accountants, they seem very indifferent on it. The reason why the taxation is almost the same.
Right. And that's the concept called integration. I mean, CRA wants the income, whether you're receiving it as a personal individual or from a corporation and then paid out as a dividend. They want the tax rates to match up somewhat.
It wasn't accidental.
Yeah.
But the one thing that's interesting, though, if you have a low income, if you don't have other income,
Right.
and your income's around $50,000 to $60,000 and you're taking dividends out, believe it or not, there's almost no tax
Right.
in Ontario anyway. It's just the dividend tax credit, how it works, almost offsets the full tax that's owed on it. And it's almost like a loophole in the system. It
Right.
goes up quickly after that. But if you're in a low income bracket, taking dividends out of a company is a phenomenal strategy. We're talking about dividends versus salary. But dividends sound pretty awesome, don't they?
Yeah. And when you think about dividends, even as a personal individual, they're taxed more favorably than other types of investment income.
So why would you take a salary other than reducing the taxable income in the company? What's some other reasons for taking a salary?
Well, if you're thinking about long-term planning, taking a salary out of your company, even if you own the company, it's still employment income. So the statutory deductions that would typically occur when you're a salaried individual are CPP, which you will make contributions to as a long-term retirement income source. And on top of that, RRSP contribution room is calculated on T4 income or salary.
So it gives you some type of long-term savings plan in there too. So that's the
Exactly.
advantage. CPP is tricky because CPP is a medium investment for someone that's employed. When you're self-employed, the problem is you're paying both sides of CPP.
Yes.
Which makes it doesn't seem like the greatest investment plan. We have to pay both sides of it.
It is still a forced savings, but you are doubling up what would typically be the responsibility of an employee. You have to pay it as the employer as well.
And there also are tax credits to go back if you do take a dividend into the company. So you got to remember that. And that gets to be a much more complicated area. But as you take money out of the company, there are tax credits that go back to the company if it has earned, let's say, dividend income in between. So there's a lot of different, and again, this is where you really need an accountant because it gets pretty deep when you get into this. Also, we talked a bit about something called a capital dividend account. A capital dividend account is where that other half of the capital gains go. As also, if you have any insurance proceeds go there. You know how insurance is tax-free if you're an individual. In a company, how they make it tax-free is it flows to that capital dividend account and can be taken out tax-free in the future. The capital dividend account, everyone thinks it's an account. It's not really an account.
It's record keeping, essentially.
It's record keeping. So you track where that stuff is, and that gives you the ability to draw some money out of the company on a tax-free basis. There's other things inside, too, that you find when you look at corporate papers. A lot of times there will be things like shareholder loans. And shareholder loans are when you put money into your business. Essentially, when you put money into the business starts, let's say it starts with zero. Right. It needs some capital to start. Where's the capital come from? Well, it comes from the person, generally. Right. So you take money, you put it into that business to get it started, or it might need an inflow of cash along the way. And that's called a shareholder loan. Now, over time, the company always owes you that back. And again, when it pays you back, you're not going to pay tax on it. You gave it. It was your money.
It was after-tax money that you contributed.
You can take that back free anytime. So when we get into this whole corporate structure, this is why, as I said, it really gets a bit more deep because what are your choices? Well, I can take money out of the capital dividend account. I can take a salary. I can take dividends. I can start to repay my shareholder loan. And you have all these different things that go on in there. So again, there's a different combination. No one's the same. Everyone has a different combination of what's going to work for them and depend on their own situations.
What you're pulling out of the company, depending on whether it's going to be taxable as salary or dividends or not taxable, money coming from the capital dividend account or shareholder loan, that has to work in concert with your personal income, just to make sure you're paying the least amount of tax possible.
In the end, how you pay yourself as a business owner really matters. It affects your taxes, your readiness for retirement, and how stable your personal finances will feel monthly. There is no single right way to do it, but when you base your decisions on the real numbers, in a lot of cases, use a mix of salary and dividends, you're usually setting yourself up for a good retirement and a good system.
Right. Like if you're sitting there and you're thinking, I'm not entirely sure if I'm paying myself the right way, check the show notes and book a meeting with us. And if you're still earlier in your journey and wondering whether incorporating even makes sense for you, we've covered that in episode 337. It's a good place to start before you even get into the whole salary versus dividend payment situation.
We've talked about a lot of stuff. What are some strategies to optimize your compensation out of your company?
You have to start thinking about what your living expenses are, what your budget requires, and determining from there what you need to be pulling out of the company.
It makes a big difference. A company's not this big open hole where you're just grabbing money.
Right.
You need to really treat yourself as an employee of the company. And that way you can keep the cash flows on. Where I find people go really poorly is when they just live off the whatever's coming into the company. They don't know where they stand. People have a budget of what they're spending, what they need to live. It's a great starting point.
I think another strategy that people could take into consideration would be pulling out of the company as a salary just enough to be able to generate RSP contribution room and qualify for the maximum amount of CPP benefits.
The one thing we forget about is, in this podcast, we're all very positive.
Right.
We're assuming every company is going to be successful.
Right.
So again, this is one thing that you have to go, when you're doing a company, the idea of a corporate structure, one of the main things is limited liability. That means if something happens to the company, it's a separate entity than yourself. And a lot of times it makes sense to continue to make sure yourself is protected aside from the company. And that's doing your RSP contributions, making sure you have CPP. Because if all of a sudden something dries up in your company, that business comes to an end, and let's say it goes bankrupt or something like that, you want to make sure you still have a life. Doing that generally makes a good sense.
What other strategies can people take advantage of?
Dividends are great. As I said, in low tax brackets, dividends can be a phenomenal way to get money out. It also has the advantages inside the company for taxes. So that's a great way to get money out of the company. And you have multiple compensation scenarios, salary, dividend, blended, repayment of shareholder loans. And you can see the tax impact. You can calculate that pretty easily to find out what that's going to look like for you.
What people have to understand is whether you have a corporation or you're personally employed, whether you're having money saved within the corporation or you're utilizing your RSPs, at the end of the day, it's going to be your retirement income source. So planning accordingly to determine what's the best tax situation for you in the year that you're earning the income. But again, whether it's $1 million saved in the corporation or $1 million saved personally, that's still just going to add to your retirement income source.
Another thing to remember too, HST money is not yours.
Right. Yeah.
I tell you, it's a key business. I've seen people go wrong in business. They forget they're collecting HST and they just ignore it.
Right.
And that's one thing the government will get on you pretty quickly. And I've seen a lot of restaurants and different places go under for that, not paying their HST. So keeping good books is key in keeping a good business. Well, thank you very much. That brings us to end of another episode with Think Smart with TMFG. Thank you for listening to the Think Smart podcast. I'm Mike Connon with the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description.
This program was prepared by Michael Connon, who is a senior financial advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice or contact me at 905-771-5200 or visit tmfg.ca to discuss your circumstances prior to acting on the information presented.